people get a letter in the mail, me included. You get a letter in the mail from Smith, Jones, and Kramer law firm. You're going to open it. First of all, you're going to open it, and you're going to open it right away. Then, when you see that it's a debt collection, then you may take it more serious if you got it from XYZ Collection Company. You may say, oh no, it's an attorney, then they can do some things to me that others cannot. I'm here to tell you that that's not the case. These attorneys, whether it's Smith, Jones, or Kramer, they have to abide by the same rules, the exact same rules, the exact same laws as every other debt collection agency. Just because they have attorney and they have their JD because they went to law school does not mean that they can do anything more to you than any other collection agency. Now, whether they'll negotiate better with you or won't negotiate better with you, or will they just say, okay, let's stop collecting on these people and try to go to court with them faster or slower than anyone else. That's to be seen. So the same collection agency, that's XYZ Collection Agency, can do the same thing that Smith, Jones, and Kramer can do. And Kramer and Smith, Jones, and Kramer does the same thing that XYZ Debt Collection Agency does. So you treat them the exact same way. So if you've ever listened to the show that I did all about collections, if you haven't listened to that show, then I suggest you go back and listen to it. And you're going to deal with them in the exact same way. When they contact you, you're not going to agree to anything. Not one thing. Don't even say, I think about it. Do not say, I think about the debt. I think about paying it. Don't even say, well, maybe I can do so-and-so on this particular date. Don't do any of those things. Tell them to send you some information. And stop calling me. Tell them do not call me anymore. If you want to contact me, send me something in the mail, in the snail mail, by the U.S. Postal Service. Do not call me anymore. I don't care who calls you. I don't care if it's Smith himself, or if it's Jones, or if it's Kramer. Do not talk to them about the debt, because what will often happen is they are skilled, even at XYZ Collection Agency. They are absolutely skilled at getting you to halfway commit, partially commit to doing something with this particular debt. And you don't want to get yourself into any trouble at all when it comes to debt and debt collection. So I want you to be cautious with them. Tell them stop calling you. Tell them to send you something in the mail. If you decide to contact them and take care of your debt collection, then that's what you're going to do. Go back and listen to the show that I did about debt, about collections. I think it's called Collections, How to Handle Them. Go back and listen to that show. It's still good for today. I did that show a couple of years ago. It's still absolutely correct and way you should deal with collection agencies when it comes down to that. So, Alexis from California, thank you so very much for contacting me. Again, like I said, you guys, you can contact me at 800, that's 800, at creditscoreman.com. Or you can hit me on any one of those social media websites as well, sites as well, and ask your question. I will answer you, and then you may become a part of the 800 Credit Score Man Show. Alexis, welcome. You are officially a part of the 800 Credit Score Man Show family. Thank you once again for contacting me. All right, so let's jump back into the show. So we talked about your good debt, well, a couple of good one good thing anyway. We talked about mortgages. So mortgage, good debt for you. We talked about car debt, bad debt for you. We talked about those credit cards. That's bad debt for you. So what else? What's something good that can be for me when it comes to debt? Because debt is necessary. It actually makes the world go round. I owe you something and you owe me something in terms of services or goods or a product or whatever, and I owe you something. We have a national debt. We need a national debt. May not need to be as high as it is, but we need a national debt because that's how the world, turns. So you're going to have some debt at some point in time. So here's another thing that could be positive for you. Lines of credit. So lines of credit associated with your home. So oftentimes you can get a mortgage, if you will, on your home, and it's a line of credit. Works typically almost like a credit card. You might get a card nowadays. Some companies are doing that. You might just get checks that you can write, and it's all based off the equity in your home. So typically it's called a HELOC or that's home equity line of credit. HELOC, home equity line of credit, or a HELOC. So you can get a HELOC, and that would be good debt. Now, why in the world would this be good debt? It's like you're getting a second mortgage on your home. Why is that? Why is that? Why would you even consider that to be good debt? Well, the reason that this is good debt is because it is associated and attached to your home. Now, let me make this disclaimer before I go on. There are new tax rules in effect for 2018. So if that hasn't been removed, then you can write off the interest from your HELOC just like you do write off the interest, from your original mortgage. You can write that off. So if that's the case, then that makes this partly good debt. Not only is it you're using an asset that you have, right? A positive asset that increases in value, but then if you have the opportunity to take advantage of the taxes on it, then that would be good. So instead of, let's say I wouldn't do this, but let's say you were financing your vacations on a credit card. So not only are you doing that on your credit card, say you got good credit and you got a card at 14%. So you're not paying as much interest, but you also can't write that off at all. Now, if you use your home equity line of credit and you pay for your vacation, your interest rate is much, much lower. It's probably half that. So if let's say it's at 7%, so you pay less in terms of interest, but at the same time, if you're able to write off the interest, then it's like a win-win for you. So that makes your home equity line of credit a good asset, a good debt for you when it comes to dealing with your credit. So that makes a lot of sense in that regard. That makes it a good debt. Now, what else could you use your home equity line of credit for? If you're an entrepreneur and you're starting your business and you're not crowdfunding or you don't have a bunch of money saved and you're starting your own business, it's better to use your home equity line of credit than it would be to use your credit card to finance your business. Now, you've also got to be careful now. You don't want to lose your home using your home equity line of credit. You don't want to lose your home by it because you can't make those payments. So again, you've got to measure your debt. You've got to look at your income and see if you can pay it back and you're going to pay it on time. But entrepreneurs, it would be good. This is about using your assets and your value and your power and the tools that you have to do better for yourself. So a home equity line of credit may be able to do that for you. What I want you guys to take away from this particular show is to change your mindset. You need to change your mindset. One, it's never too late to get your credit straight. That's just something I came up with last week and I thought it rhymed. So it's never too late to get your credit straight. So that's one thing I want you to come away with. You got to change your mindset. And two, I want you to look at your credit as the asset that it absolutely is. So it's not a detriment to you if you do it right. If you have a good credit score, if you've got a lower credit score right now, you can work on it and you can move it in a positive direction. It's a powerful tool in your financial arsenal. So you've got all these things that you can do. You can use your 401ks. You can save money. You can, you can get 0% credit cards for a particular point in time. So you can help get yourself out of debt and stop paying so much interest. Those are all financial tools that you use, right? Your credit is a financial tool in your arsenal. So you got to use it in a way that helps you and benefits you. So good or bad debt or even no credit at all are all can all be determined by so many factors in your life. Or I mean, they can determine so many factors in your life. So if you got good debt, it can determine what you can buy, what you can't buy. If you got bad debt, it can determine what you can buy, what you can't buy. If you have no credit at all, then it can determine how you can navigate. So you want to make sure that you get your credit scores up for sure, so you can maybe help move through life a little smoother than normal. And you want to max out your buying power. You really do. You want to max out your buying power. So when you have better credit, then you can max out your buying power. So you might have good income but bad credit, which means, okay, we need to limit this person on how much home we can allow them to buy. If you got good credit and good income, then boom, you can max out your buying power if you want to do that. Don't now I wouldn't suggest that you be house rich and cash poor, but if you want the big house on the hill, then you need to get your credit together so you can get that done. All right. Now, you can do all this by increasing your credit scores, right? So if you increase your credit scores, again, it's going to lower the interest that you're going to pay, and it's going to save you money in the end. And trust me, it makes things much, much easier and smoother. You don't have that anxiety when you have to go fill out an application for something. There's anxiety associated with it, even if you have a good credit score, a decent credit score. And part of this whole mindset, and the reason this show even came about, and this portion of the show came about, was because oftentimes what we do is we think that we're in a worse situation than we actually are. In this day and age, when you can be approved for a mortgage with a 580 credit score, then you're probably not as bad off as you think that you are. So I want you to change your mindset and not be afraid of credit and afraid to even try to go somewhere where you can get the better rates. And I bring this up because I saw a sad, sad, sad story on the news about payday loans. Here we go with payday loan places again. If you listened to the show before and you caught them all, I've talked about payday loans a couple of times before. And when I'm talking about necessary evils and whatnot, I don't believe that they're a necessary evil at all. I really don't. And after listening to this particular story, I find it to just be evil. Just quite frankly, it just be evil. So the story that I saw on the news was about an older lady, over 65 years old. She ended up borrowing about $8,000 from this particular payday loan place. They were taking fees out in addition to what her payment was. They were taking fees out, and in addition to what her payments were, directly out of her bank account. She had got a little elderly, and her son moved in with her. He, started going through her business, and he saw this from this particular company kept coming out every month. Well, when they went to investigate what happened with this payday loan place and the money that she's borrowed, what they found was that she paid back between $35,000 and $40,000 off of $8,000 that she borrowed. She just didn't know that that's what she was doing. She signed documents that said, one, you can't sue us. There's arbitration in here. So if there's an issue, then we have to go to an arbiter and they'll decide what's going on. Right in the top left portion of the papers that she signed, it said that her interest rate was 145%. I said it slow so you can get it. I had to rewind my television so I can see that for myself. 145% was her interest. And at the time, it wasn't even illegal. They could charge her 145% and they can roll on. So this lady borrowed $8,000. She paid back between $35,000 and $40,000. She went to a payday loan place. So this got me to thinking. This got me to thinking that oftentimes we go to places like that because we think we can get approved better because we think our credit scores are bad. I'm going to tell you right now, it's better to just go to the bank, call your bank, and let them tell you no. Let them tell you no. Let them show you or tell you what your credit score is so you know where to navigate and where to go next. If the bank won't help you, go to the credit union. Go to the credit union. But way before you go to payday loans, don't think that it's simple and it's faster. The bank can get you in and out just as fast as the payday loan place. You do not have to go there and pay outrageous interest rates. Then you could also go to places that do personal loans. There are places that do personal loans, and that's what their forte is. You can go there and get a personal loan. They can have you out in 20 minutes. They can have you out in half an hour. But do not stay away from those payday loan places. If you can stand it, stay away from those payday loan places. If you owe some payday loan places right now, then you need to cut it off. Don't go back there anymore except to make the payments, and you need to make more than the minimum so you can get out of the mess that they have put you in or that you put yourself in. So that's why this whole show even came about. I want you to change your mindset when it comes to that. You think